Good morning, traders. Mark Heworth here from Flipside Trading, and it's Sunday morning on April 26th, and lots happened in the market. So let's take a look. Let's dive in deeper more this time. Let's start with our trade for our SPX April 24th, 27.25 put vertical. Let's do basically a recap into that, why we chose the trade, why we managed it the way we did. And then we'll get into the market overview and talk about earnings and some key decision points and what the health and the strength of the market looks like and what we can expect next week. All right, man. So without further ado, let's jump in and take a look at the charts. Okay, so the first thing we do when we're looking at putting on one of these overnight 24-hour credit spreads is discerning the trend and identifying key support and resistance points. So if you look here on the daily chart, remember we're putting this on Thursday morning, okay? So in general, what you see is even though we had this big down day on Wednesday, we totally reversed and gapped up and exploded. So this really indicates a change of sentiment from, kind of breaking this trend line and going bullish and almost saying, hey, this is probably maybe a potentially, fake look below and then come back through up top. In addition, we had support on the daily from the 8 EMA and the 21 EMA. So if we can get below those two key levels, excuse me, those are good places to find that protective support. And we did, and we came right here and looked at 27.25 for about 25 cents. So that's kind of the key part, at least on the daily, but we have to look a little bit deeper. And we look a little bit deeper, and we go into the hourly chart as well to make sure that the hourly chart is in alignment with the daily chart. We come here and we look at the hourly chart, and we can see that we kind of, bounce back in. But the key thing is we want to really look at is, are we having, number one, in this section here, right? It's coming up through Thursday. Let me kind of redraw that for you real quick. Remember, we're putting this on Thursday before 10 o'clock in the morning. So if we look at this section right here, right, you can see we have higher highs, higher lows, okay, all the way up through. We have accelerating momentum. And at this point in time, if you kind of look up, it crosses zero. So that's telling us that we're going to be bullish at that 27.25 strike. So, of course, we move along that day, and we have an announcement, right? A news announcement that comes in, and Gilead is one of the key leaders in the biotech field that's working on a vaccine. And they have a vaccine called Remdesivir, and and basically they're saying the initial trials did not, return the expected results. So this huge drop right there, kind of this big liquidation break. And then all day, okay, the market kind of bounced around, but not only that, it changed the volatility in sense that it totally increased it such that our credit spread went from, being basically profitable to being down in the negative standpoint. And the goal was, okay, if we can close above 2,800, that we would hold it overnight. But it really put us on kind of a treacherous footing, saying there's some potential, weakness in the market. And it closed, I think, at 98, right? So we're like 2 points under, so we're right on the hairy edge. So there you go. Okay, remember, we don't know, we can't see this yet, right? We don't look in the future. We're only looking, from here and then trying to make decisions. So let's look a little bit deeper, and we'll go to the 5-minute chart, and we'll show how we managed this on Friday and why we made some of the decisions that we did. So if we go back here on Friday, we're going to back it up to about that, 10 o'clock time. Okay, so we're seeing here that, let's see, what it moved it too far. Sorry, guys. That's one thing about Thinkorswim. It is a little finicky from the charting perspective when you're really trying to show some key points. All right. Sweet. All right. So this is all Thursday. We start here on Friday. We gap up, and immediately after gapping up, we start moving down. So showing weakness in the market. and basically underneath this overall trend line. So it's showing our top of the trend line is kind of holding number one. Number two, we keep pushing down to this 50% level, and we hit it once, twice, three times, four times, and we come up here, and usually when you hit something three or four times, like that fifth or sixth time, it doesn't hold anymore. And sure enough, it didn't, right? It didn't hold here, and we broke yesterday's low. So when you break yesterday's low, that's also a pretty good support indication. On top of that, let me draw it. We have kind of, when we look at the trend, and we'll draw it from here. And if I add a drawing and I add a trend line and I drop it through, right, I can see I have a downward trend and I had this horizontal and I'm breaking it. So I'm like, whoa, okay. Based on yesterday's market weakness, this is kind of an alert signal for me. And then it kind of it bounced down. Again, we broke the previous day's low. So we don't look at just price alone. We want to understand some things around what I call my market internals. So I'm going to go ahead and show you what my market internals looks like. And we'll talk about these things here, these different panels as we go across. So number one, this is the NYSE ticks. And basically this talks about we'll get an uptick, someone's buying, versus a downtick where someone's selling. And if I look at the balance of what's happening on Friday, you can see that the majority of the volume, okay, is downward, right? We're below zero. And matter of fact, we're touching this minus 1,000 level. So it's telling me I had this preponderance of, if you say, negative sentiment and negative buying in the market. Then I come down here to my advanced decline. And what the advanced decline is it tells me our stocks advancing versus the stocks that are declining. Well, man, I'm declining, and after this huge push down, I'm getting this consolidation. And a lot of times after this consolidation, it's continuation, right? I would expect to see another leg down. Same thing, volume spread, right? As the market activities happen, is it negative or is it positive? Well, what do you guys think, right? Looks pretty negative. Here are the moving averages. It's all underneath. If I look at volatility, volatility is not as clear cut, but I do have, a key spike and a break of this, trend line, kind of right here at this point in time when I'm trying to make a decision what to do. And then, of course, look at the other indexes. I'm underneath value. You can see here that I'm moving down in the NASDAQ, and here is the small caps, the Russells, and again, right, we're breaking value. So based on, we had some time decay and everything else, I went ahead and made a decision and said, personally, I'm going to go ahead and cash out. So we got 50% profit on that. Now, if you just, on the other side of this, you can say, look, we are kind of breaking down, but we're breaking down at this point in time. The SPX, we're still, kind of 60, 65 points away. I can still manage. I think that is also a valid decision. And you know what, in this case, if we go back to our 5-minute chart, let me get rid of this good stuff for you. That's, we broke this over, this support definitely kind of held. It was kind of more or less a run on stops. We broke through, and especially this last touch here, I was able, to go long on a day trade, and, things worked out. But, just given the market and the way it is, it's, it just pries nerves. And the reason, too, is, okay, we know that technology and the FANG stocks have really been driving this market. But what the market likes to do is, so let's take a look at a couple of those. So look at Amazon. And we're going to look at it. We'll go back to a daily here. Sorry about that. And we'll take a look at Facebook and a couple of those as well. But if you look at Amazon, who has earnings coming up on Thursday, you can see that from a daily chart. And if Thinkorswim decides to participate, we'll be there in a second. But you're going to see that it's, look at this huge run that we've had, right? It's really extended and almost overvalued, and it's in this basically, high and tight, you know, consolidation. But what the market likes to do, like with Netflix, who also saw that same kind of a run, is they love to run it up. And then a day or two or sometime before, they love to just bring these down. And that happened right here on Netflix. And this is an up day in the overall market. This is the day before earnings. They love to just slam this down, and then you see I had earnings here, and we kind of, chopped. So my concern was on top of that is we were extended. It was a Friday. I thought maybe people were going to take profits. Okay, based on all those things, was I wrong? Yes, the market definitely did something different than I thought. But again, it was just kind of prudent management based upon those risk factors. So that's just the way the market goes sometimes, but we're able to put some money in our pocket, and there you have it. Okay, so now we want to take a brief look at where the market is going to be, and look at the overall health, and also take a look at some of our sectors that we talked about a week or so ago, and see how they're performing based upon the new Corona economy, if you will. So go here to a web perspective, and so when we look at the health, the first thing we're going to do is look at a broader base, right? We look at the broader base of basically the New York Stock Exchange, which is 3,500 stocks versus the S&P 500, which is only 500. And you can see here that what we have from the cumulative advanced decline right here, it's still underneath the 50 EMA, and that we're chopping around in this horizontal piece. So if we come above this 50 EMA and we break this overall support, then I feel very strongly that we can get very closer to all-time highs. But for the moment, you can see there's a very good correlation that every time that we break this 50 EMA or stay above it and bounce off, you can see that there's a really good correlation that the S&P 500 will react accordingly. Okay, so based on that, you can tell that we're at a pretty key decision point. So let's take a look at the next piece. So again, we're going to look at here's the SPX, and I think I'm going to let's see if they did something to me. Yeah, okay, we'll go back. Look at the SPX, right? We'll get a little narrower now, and we'll take a look at this from an overall breadth perspective as well. Okay, again, you can see that we have kind of this horizontal resistance on the SPX. And what we're looking at down here is the percentage of stocks that are above the 50 moving average, and here that are above the 200. And in both cases, you can see there's some key correlations where, when we're above 50 and we start moving above 50, that the market starts to move, right? The market starts to move. So right now, we're at that point where we really don't know what's happening. The same thing, on-balance volume provides a really good correlation, an indicator of when we cross this 50, right? Cross the 50, right? We get a nice move in the SPX, and right now we're still just sitting below it. So again, I think we're waiting to see whether or not we take another break and move up. We break the on-balance volume, we break the percentage of stocks that are underneath this 40% level, and then we'll probably end up breaking here. And if not, conversely, if we don't break those and this serves as support, then we expect to see the market pull back. Okay, let's take a look at a broader perspective now on some other factors. That was the technicals. Again, let's look now at the worldwide factors. When we look at the worldwide factors, we can see here, this is our world stocks minus the United States. And yeah, we have a little bounce up, but man, that's positive. And we talked about, even like this week, we thought we'd see the 618, but we haven't really broken the support line yet. So there's no real acceleration, that's happening. So the world as a whole, I should say, is still serving more or less as an anchor on the U.S. markets themselves. If we take a look then, okay, on the broader piece, the BDI, this is our shipping index. If you guys remember, about 80% of all goods end up being shipped over water at some point in time. We've had a little down tick right here. We haven't crossed that threshold, but again, we're going to want to see, is this going to continue down or is this going to bounce? We're at that key inflection point at the moment, and I'll talk about why in just a little bit, why all these are at an inflection point. So one more time, we can look again. Now we want to look at the VIX, right? This is our fear gauge, right? Based on overall sentiment. This is saying whether or not folks are buying out of the money puts to hedge their long positions. And you can see here that we went up, we broke this wedge, okay? The market did go down that day, and then since then, on Tuesday, we've really, the sentiment is becoming down here, and we've had less and less fear, and that's because the Fed keeps saying that, hey, we're going to keep buying. I mean, Mnuchin came out and said that potentially we're going to buy oil equities, right? Going more and more to that Japan model. But again, we've come up to this confluence of these two lines. And so if we break this, then I expect the market to go higher. But now we have this double piece. I think there's a reasonable probability, at least 50-50, that the VIX would go up. And if the market correlation holds, if the VIX goes up, then the market would go down. Let's kind of drive through a little bit more here on the next piece. And we want to talk about credit, right? Because the whole market is run on credit. And what we're looking at here is HYG in relationship to our normal, 10-year government bonds. And the idea is that if we're buying more and more high yield bonds, that is a risk on indicator versus if we're buying more, government type treasuries and bonds. Especially here, the IEF is about the same duration as government bonds, that 7 to 10 year frame. It means that it's risk off and we're a little bit more, conservative in what we want to do. And you can see that we came all the way up to this level here, and from a high risk standpoint, and now this is kind of an advanced indicator, is we really started pushing back down. And so, because at that point in time, what really drove, kind of this leg was, again, the Treasury said, hey, we're gonna start buying some of these, HYG bonds and LQD bonds, and in order to support the market. But I should say the bloom has kind of faded off that rose a little bit, and we're down here. So until we see, a break above this level, I really wouldn't expect the market to go higher. So I really would want to see a change, an inflection point here, from a longer term perspective, to say that we're out of the woods and that Corona has been tamped down and our overall demand has really started to increase. And the other thing you have to remember, guys, is that the bond market is like 20 times bigger than the stock market. So listening to the bond market signals is always something you should at least have in the back of your mind. Okay. Unemployment, we had the unemployment numbers again. If you remember, we were at 20 million at the end of last week. Now we're at 25 million. So again, why is this important? Well, the economy is about 70% run by the consumer. And if the consumer doesn't have a way to generate wages and buy goods and service their debt, well, that can have an overall drag down on the economy. At this point in time, it's not, right? You can see that the market is chugging sideways, and the reason it's chugging sideways is because we have so much federal support. The question is, can we print money long enough and fast enough, to keep this, should we say, negative income flow from the consumer at bay? And that's a decision I don't know, right? I don't know what the Fed is going to do next, so we have to wait and see what the market tells us. And what's the market tells us to do something based upon all the triggers we've seen, then we'll know what action to take. And so let's take a look at what we talked about last week, right? We said pretty much, and you can see here what I did is I extended the lines from where we were into be the yellow, and we had the last discussion about it. This was kind of in the red. And we said, okay, we got up to here, we could break up and move up to the channel, or we can kind of hit this and kind of move sideways. And that's kind of what we did, and we actually broke down below. And we're still moving up, but we're moving up, okay, against this rising trend line. Now this rising trend line can probably come all the way up to, again, let's see, go to screen draw here, and this level, which is a 618 retracement. Now, next week is all the big tech earnings. Facebook, Amazon, Google, okay? You have to realize that that sector represents 21% of the SPX because it's a cap weighted index. So if we have good earnings associated with those stocks, then I would definitely see us not only get to the 618 but break it. I think potentially that we will rise in the first day or two because I think they're going to bid everything up. Okay, this is just pure speculation based on history. Not saying it's going to happen. I would see them bid it up for a day or two and then start to have some pullbacks before earnings kind of to shake out the weak hands. And then if the earnings come out to be positive or better than expected, then we will break up. So that's the kind of the action that looking at for next week based upon not only the technicals but also some historical experience. All right, folks, hope you're having a great weekend. I hope that your family is safe and that you're resting in kind. Should be another exciting week in the markets. I hope you're doing well. Oh, real quick, I'm sorry, I forgot. I wanted to go back and show you, some of our, should we say, sector picks from the ETF standpoint and how they're doing and why we did that. So we'll go back to, real quick, so we started off kind of in a health sector, and that's XLV. And we have XLV here, and what we're looking at, here's the XLV chart performance on top. What we're looking at down here is the on-balance volume. You can see that we're up here, we're almost breaking the 50. But the key here's XLV versus SPX. So if XLV is doing better, right, that makes it a larger numerator, then this graph is going to go up. And as long as this graph is going up, it is outperforming the S&P 500. And that's our goal, right? We don't want to just, meet the expectations of that benchmark. We want to exceed them. So right here, yep, you can see that we're moving forward. We also talked about, in the health sector, we talked about IBB. And let me see if I can type correctly. And you can see relatively, right, S&P 500 is only at 50%. We're up here almost at a new top. The on-balance volume has broken the 50. We're up. Again, we have an upward moving line, which means that we're outperforming the S&P 500. So there's kind of the key things we're looking at. You even look at XBI, which is kind of the smaller caps as well in the health sector. Oh, I'm sorry. Again, there's a finicky piece here. I'm just going to delete that. Let's get XBI. And right above the 50%, above, basically upward sloping trend. And then we'll get to the technology side of things and we'll look at FDN. It's one of the key things we talked about. Again, you can see we broke the key moving averages. We're above the 618 retracement. We're above unbalanced volume. Boom, up. We talked about Sky. So the picture is the same, right? Really pouncing up, really moving over. And we take a look at XLK. All right, XLK showing a little bit more weakness here on the on-balance volume. I like to see that move up. We're a little bit flat here. But, so it looks like we're really just on par with that. So unfortunately, they don't all, work out. I wish they did. And if I did, we'd all be on an island somewhere. But, you can see at least that we're holding our own. And then I guess the last one we took a look at was the semiconductor from the new technology perspective. And you can see, again, they're just about the same way. Okay, but then we talked about some initial stocks. If you're looking to play, do some stock picking things. So we can take a look at Zoom. Zoom was doing pretty well. It got hit really hard because Facebook announced that they're coming up with a competitor. Usually what happens is that this becomes point to buy. If you kind of look at Netflix, it's the same type of history, right? You have, all the different streaming program. Apple had their own streaming, right? Comcast is streaming, ABC is streaming, Disney is streaming, but Netflix just has that overall, technological and market first mover advantage, and I think Zoom does as well. I expect to see that bounce. We looked at telemedicine. I think that was TDoc. Yep, still moving up, doing well. Again, above down balance volume, moving straight. We talked about DocU. If I can type right. Boom. Okay. Same thing. We're moving up here, right? Above the highs, above the moving averages, above the unbalanced volume, and relatively SPX, we're doing really well. Okay, guys, so that's the key thing, right? We really, you can do this not only, with these sectors, but as you can see, you do this relative performance in association with the SPX. That'll keep you hopefully moving ahead and moving your portfolio ahead. This is a really good way to, determine, what's moving and what's not, and kind of where to be from an overall sector evaluation perspective. And then remember, if you like the sectors and like an ETF according to it, and you want to do the stock pick, look at the top 5, right? Because the top 5 are going to move the sector. And again, I think that from a stock picking perspective, it provides you a higher probability type of way of analyzing the market in order to choose the correct stocks. Okay, folks, now we are signing off. Thanks a lot for your time. Take care, enjoy the weekend, and we'll catch you on the flip side.